Hi, I'm Tom Selzer from Livewire Markets, and today I'm joined by Will Liu from Wilson Asset Management to get his expert view on the US market and the companies and topics that are on their radar right now. Thanks for joining us, Will.
Thanks for having me, Tom.
Will, we've just come out of US reporting season. What would you say are some of the key takeaways there, and maybe what's the sentiment like amongst US investors at the moment?
Yeah, it's been an incredibly dynamic US reporting season. I think the setup is really interesting because you had companies guide in April when there was peak tariff uncertainty. We'd just come out of Liberation Day. And so they guided relatively conservatively. At the same time, you've seen equity prices run up into results season this time around. And so we've been in an environment where beats are kind of expected and misses have been severely punished. So we've seen that across reporting season, and it's really a function of the positioning that's happened within markets. When I look across the sectors, you've seen generative AI continue to be super topical, super hot space. We're seeing a lot of capital flow into the data and infrastructure layers of the information technology sector. And at the same time, you've seen question marks on whether software, the business model, is a little bit more challenged, whereas historically it's been a great performer in US global equity markets. When you look across the cyclical landscape, when you think of housing, transport, construction, we've seen the recovery really pushed out. So we're not seeing earnings strength yet. There's still a high degree of uncertainty with the eventual impacts of tariffs. Interest rates are still high. And so management teams that we speak to are very hesitant to make big decisions in light of this uncertainty. And so we're seeing the recovery pushed out a couple of quarters at the very least. The consumer, surprisingly, has been quite resilient. There hasn't been a lot of changes. And so overall, it's been quite an optimistic, upbeat reporting season. US companies have been very resilient in the face of uncertainty. And then I would say sentiment is, it's been kind of a reluctant positivity just because everyone thought tariffs would have this huge economic impact. And the reality was it wasn't nowhere near as bad as people expected. And so you started to see capital slowly flow back into markets, and we've seen the rally that's subsequently happened. So we're still optimistic on the outcome. I think September rate cuts are going to be a big part of the story, and we'll see what the eventual tariff impacts will be. But most US companies are quite resilient, and we expect them to deliver pretty strong compound earnings growth going forward.
And just moving to your fund for a moment, WAM Global looks for undervalued growth companies, but can you explain maybe a bit more about the process that goes into that?
Yeah, exactly. We're very focused on finding undervalued growth companies with a catalyst. The process is, like, when we look for new ideas, we're really looking for high quality growth companies. And then the valuation piece is quite tricky because you would think about valuation as a cheap PE ratio, but we think that's probably too simplistic of a view. What we found where we've gotten a lot of good results is where we can be really, we can do the fundamental analysis, we can look at companies from an earnings standpoint, and we really like companies in structural growth areas of the market where the earnings can accelerate relative to expectations. And so you find a pocket of companies where you've got really strong earnings growth, upside surprises during results season, and maybe the PE from an outside viewpoint is not optically as cheap, but we think there's a huge runway of growth, and that earnings growth will eventually drive share prices. And those are the companies we tend to find. Some of the key structural growth areas we're finding a lot of opportunities are generative AI as a theme. We're seeing topics such as electronifying marketplaces, critical infrastructure in the US. And so we're finding a lot of opportunities, and we're meeting those management teams. A big part of our process is getting in front of them, building that relationship, understanding and being very close to the company so we know when an investment thesis is playing out or when there's a shift in sentiment or something's changed within the business, that we're aware of it and can make a considered decision whether to buy or trim the stock and actively manage the portfolio in that way. But I think the catalyst is probably the final component and really keeps us nimble. It means we don't have as much stale positions. We're looking for companies that can consistently deliver us earnings. And I think that's really important in this environment just because we're seeing a lot of passive money come into the market. In the US, there's a lot of talk about these pod shops, which are very momentum oriented. And so being able to be long-term investors, look at it from a quality lens, long-term earnings growth, but also be mindful of what the short-term catalysts are, really position us to outperform. And that's how we look at it from an investment process perspective. And we're all generalists, we all love comparing companies, meeting these teams, and we're excited every day to come and sort of find those opportunities for our investors.
And it seems so much of the outperformance of the global stock market recently has been down to a handful of big US stocks How do you guys manage that as an active fund that's looking for value in mispricings in the market?
Yeah, that's completely correct. Like, it's been quite a narrow stock market. The economy has been resilient, but the real strength has come from information technology, infrastructure investment, the digital layer of the information technology stack. And so the Magnificent Seven, extremely good companies, clearly at the forefront of technology, but they're very well researched, very hard to get an edge, and also extremely consensus at this moment. So we tend not to own a lot of the Magnificent Seven. We found we do own Google, and that was a unique opportunity where we bought it when the market was too fearful that ChatGPT would disintermediate its search business. And we had this view that they were vertically integrated, they had unique data, they had strong LLM capability, and they were going to be a generative AI winner. And so we took a sort of counter consensus view at that time, which has since played out. But honestly, it's been quite difficult trying to keep up with the market, finding those opportunities outside of the Magnificent Seven. I think we've done a fairly good job, and that really comes down to finding other structural growth thematics. We're also very exposed to the small and mid-cap part of the market, and we're finding some really interesting opportunities there, particularly undiscovered, under-researched. And then we've had a few positions where they've been acquired by larger companies just simply because the valuation disconnect was too large. So it's an interesting market considering how narrow it's been. We think at some point it will broaden out, and we think we're really well positioned for that. I think when you look at where the capital's flown, it's just like when valuation keeps going higher and higher, your prospective returns go down through time. And so by staying focused on our process, finding the undervalued growth companies, we think is going to deliver more attractive prospective returns in the future. And that's where we're focused on finding, spending our time hunting and finding those opportunities.
And what would you say are some of those themes that maybe you think are going to develop over the next 12 to 24 months? And how is that being reflected in your portfolio?
Yeah, it's hard to go past technology firstly as a theme because it's such an important space. Everyone is focused on the infrastructure and data layer of the technology stack. So you've seen big build-outs, spending on CapEx on data centers, GPU clusters, and those companies have attracted a large part of the economics, and you've seen the likes of NVIDIA, AMD, Broadcom really do well in this period. We're focused on what happens next. So we need to build out the compute power. That's sort of where the wins are right now. What happens on the software application layer? Because we need to find, while all this compute is amazing and we're clearly doing some really interesting things with generative AI, what are the products and services that are going to be built upon it? Where are the revenue opportunities going to be? Where are the productivity gains are going to be? And that's a debate we're having internally because you've seen capital shift into infrastructure, data, and software has really been sold off because people are questioning, hey, this is a seat-based business model. Do you really need as many people? Is software going to become commoditized and maybe it doesn't have the moats that it typically has? And we're looking at it from a case-by-case basis, and we think we have some really interesting names in the portfolio which will be long-term winners, but they're in this period of time where the narrative is going a little bit against them. SAP, which is one of our big positions in the fund, is a really good example of that. They actually own the infrastructure data layer and they have the software layer. They're vertically integrated. They have the most important data of their customers sitting on their systems, and they're going to be a system of record. And we think they're going to be a winner that's underappreciated in the shorter to medium term. The other themes is what's going to happen with the cyclical recovery. This push out, what we're seeing right now, that's going to temper off because tariff uncertainty will subside. We think interest rates are coming down, and there are pockets of the economy which haven't really had much earnings growth for the last 2 to 3 years. Valuations have come down to a reasonable level, and they're a little bit like a coiled spring where we think there's meaningful earnings acceleration once the consumer gets a little bit more confident, once corporates are a little bit more confident in making decisions. And of the names that I think of in our portfolio are TransUnion and Intercontinental Exchange. They both have really strong nascent mortgage technology businesses, and their businesses are doing incredibly well regardless of this, but there's a story for earnings acceleration when mortgage volumes picks up and people will inevitably have to buy homes. The final structural themes that we're talking about is probably like small and mid caps will have to come back at some stage. The valuation disconnect is simply too large, and we're starting to see capital markets open. We're seeing new IPOs. We're probably going to see more M&A activity. And that might be a catalyst to drive that smaller to medium end of the market to re-rate a little bit and get sort of the credit that it deserves, because there's some really strong businesses in those parts that are a little bit underappreciated and under-scrutinized within the broader market.
I mean, you mentioned some companies there, but maybe do you have any examples in that at the smaller end of the market potentially?
Yeah, one of the companies that we really like is Allfunds Group. It's listed in Amsterdam. It's the leading wealth technology platform in Europe, and it has roughly 1.5 trillion euros of assets under advice. So they're beneficiary of a number of secular trends. So they connect fund houses with wealth managers, and there's this long-term trend where that architecture is moving from in-source to outsource, and they're the largest provider in that space, and that's going to continue to happen for the foreseeable future. It gives investors better access, better costs, and it's been driven by some of the regulatory requirements over in Europe. The thing about Allfunds is you're in a period where we're seeing a flight of capital into Europe again. That's going to be positive for assets under advice for them. We're seeing more of a risk-on appetite, which is great for them because they earn more margin on equity products, fixed income products, rather than money market products. And then finally, the valuation is just extremely cheap. We think this company can grow at high single digits, low double digits on a revenue organic growth line. At the same time, it has 65% adjusted EBITDA margins. It has a net cash balance sheet. In fact, I think 2 years ago, it had a hostile takeover at a share price probably at a 40% premium to what it is today. And the business, in fact, has gotten a lot better. They recently have a new CEO. She's Australian. We're really excited about her because she has the right background to really drive this business forward. They're going to have a capital markets day early next year, and we think they're really going to effectively communicate the key drivers of the business and help the market understand what the next leg is. And that's going to drive a re-rating as well as the earnings growth. And it's a name that we think is super underappreciated in this part of the market, partly because of its listing in Europe, partly because there is a little bit of private equity ownership overhang. But we think those issues will be resolved in time, and we're happy to own an asset delivering that type of growth at a really attractive valuation.
And finally, what would you say are the big topics that are getting debated in the war room at WAM at the moment?
One of the great things about WAM is our culture. I think even when we're in the war room, we find the right balance between having rigor around our investment debates, allowing for independent thought, and being sort of humble enough to know when we're wrong as well. So I think there's a lot of debates happening right now, like what's going to happen with generative AI? Where will the value accrue in the supply chain? Interest rate cuts, will it be a dovish cut or a hawkish cut in September? What is the pathway forward from there? What is the catalyst for small and mid caps to really outperform? Because it's been a sustained period of underperformance. And then we're constantly evaluating where are the risks as well, because it's great to find amazing opportunities, investment opportunities, but we're laser focused on identifying investment thesis drift. Are we underexposed to certain areas of the economy? Where can generative AI potentially be a threat to our existing portfolio positions? So we meet all the time. We have rigorous debate. There's plenty to discuss. But at the end of the day, the focus is really on business models, industry structure, management teams, and we sort of build that bottoms up models for our companies and investment theses. And then, like being global, you can't completely ignore the macro, so we do take into consideration those aspects as well. But it's always dynamic in the war room, and we're lucky that I guess there's great leaders there who really make sure that everyone is heard, and we can have great discussions about what's going to happen in investment markets to make the most informed decisions.
Great. Thanks for joining us today, Will.
Thanks, Tom.
Thanks for tuning in. Make sure to check out our YouTube channel for more great videos.